the Federal Reserve has been going after the U.S. economy for a year. In response to soaring inflation, the Fed quickly raised interest rates to slow down the economy and stop prices from going up too fast. Earlier this year, at a news conference, Chair Jerome Powell explained these goals by telling reporters that lowering inflation would be painful. However, tearing down the economy has turned out to be very hard. Even though the Fed has slowed down some parts of the economy, especially the housing market, the economy is still strong. It looks like it will get stronger over the next few months, not weaken. The Fed has said that it might stop raising rates if inflation starts to come back, but if the economy gets stronger than expected, it might start raising rates again. When that happens, investors and consumers should be ready for more challenging times because it will hurt both the stock market and the U.S. economy. The U.S. economy continues to grow. The real surprise is how strong the U.S. has been, even though it has been said almost constantly this whole year that it is about to go into recession. Still, there are signs that it will keep getting stronger. The most obvious reason is that it makes the supply chain less stressful. Businesses have been able to get the things they need, so customers can spend their money on what they want instead of on empty shelves or dealer lots. Cars are an excellent illustration. In October, 14.9 million light vehicles were sold, which was the best since January. The growth rate is so fast that if auto sales keep going at their current rate, they will raise the gross domestic product by an incredible 1.5 percentage points. Other parts of the economy also come out of deep holes, and this growth will be supported well into 2023 by solid demand. Think about the people who make airplanes. After the problems with the 737 MAX and the spread of the coronavirus, Boeing had a string of bad years. New orders are coming in, meaning more planes are being made, and the company has much room to grow. Of course, it was a joke. Another good thing for the economy is that the bad news is not worsening. In 2022, government spending went down, which slowed down the growth of GDP. However, this will change the following year when money from the bipartisan infrastructure package and the Inflation Reduction Act starts to flow. The Fed's rate hikes have greatly hurt the housing and new commercial real estate markets. For the past 6 quarters, the drop in building investment has slowed the growth of the U.S. economy. But after the first shock and after mortgage rates evened out, people have become more interested in buying a home. Globally, the problems that shook the world in 2022, like the European energy crisis and conflict and China's zero-COVID policy, are not likely to get much worse and may even improve. Recent changes have also been suitable for the financial markets. The Bank of America's Global Financial Stress Index is a broad measure of how the stock and bond markets are doing. It has been improving for over a month and reached the level it was at during the Federal Open Market Committee meeting in June. It is hard to say that a boom in the stock market and better debt markets for businesses mean a recession is coming soon. Recessions work partly by surprising people. When there is a shock to the economy, businesses quickly get rid of things, put off big investment plans, and stop hiring new people because they think everything will be okay. This time, though, things are different. Because there is a lot of talk about a recession, almost all businesses are getting ready for a slowdown. What happens if there isn't a recession and the economy grows faster? The method works backward. Companies will be surprised, and it will take a while to get back on track as they order more goods, try to hire more people, and start reinvesting. This is terrible news for the Fed, which aims to slow down the economy. If the first try does not work, try again. Like many businesses today, the Fed seems to be against economic growth. There are rumors that the central bank will slow the rate at which it raises interest rates because it thinks the economy is weakening enough to lower inflation. However, as I said above, the opposite is true. Real growth is beginning to speed up. The Fed will have to give up on the pivot before it even begins, making its job even harder. When the economy is doing better than expected, it is, at the very least, hard to lower interest rates. For the average American, a strong economy is both a blessing and a curse. On the one hand, the beginning of 2023 will look great. Both the job market and family budgets will be substantial. However, a happy new year could lead to trouble down the road. Even if supply chains were better, inflation would be higher than the Fed's 2% goal if businesses rushed to meet higher than expected consumer demand. Because of this, the central bank would have to act. Suppose the economy is strong and inflation stays high. In that case, the Fed will have to keep raising interest rates for longer than expected. If the economy weakens and prices fall, the Fed can switch to a more relaxed policy. The Fed could keep raising interest rates until the job market worsens. At that point, layoffs that have only happened in a few sectors so far would spread and cause more pain for households. The Fed has said that higher unemployment is one way to reach its inflation goals. In 2023, interest rates could go up in the year's first half and then drop sharply in the second half. Also, the markets will be hit even harder if the American people pay for this faster than expected growth in the long run. Investors think interest rates will go down by the end of 2023 because the Fed has recently changed its tone. There is little to no chance that the Fed will start lowering rates by this time next year. This is because the economy is doing well, and inflation might fall more slowly than expected. I would not expect a dovish bias at all. If that is the case, the stock market might see another false dawn. In an economy where bad news is good news, and the good news is bad, the fact that Americans can handle rate hikes by the Fed and record high inflation may hurt them in the long run. Powell said that bad things would happen, and they will. If you enjoyed this video, don't forget to subscribe to our channel.